Good morning, everybody. Oh, I'm Nana Balfour. I'm the CEO, Chairman, and Chief Culture Officer of Kintes. And I'm very pleased today to welcome you to the last edition of the Economics of Change for 2021, which actually happens to be the seventh edition of this thought leadership platform. We are very excited that we are closing out 2021 with a very interesting subject in the times in which we're living. This thought leadership platform, Economics of Change, was launched right at the beginning of the pandemic. And 2 years later, unfortunately, we are still dealing with some of the impacts of the pandemic. And so, first, I want to wish everybody a safe holiday season. I hope you and all your loved ones are keeping safe and observing all the right protocols to keep safe. It is interesting that we would be having this particular subject matter for this edition of the thought leadership of Economics of Change, which is basically the power of sustainable investing in driving both long-term growth and positive social impacts. I think there's been two big impacts of the pandemic that we've been all living through, which is its global impact on growth and its global impact on the society. And so it is fitting that as we are finishing 2021 and still have some of the remnants of the pandemic around, it is fitting that we'll spend some time today to talk through what it means to build a more sustainable world through sustainable investing. I am excited to have some really great leaders and thinkers on this subject around the world with us here today. In this edition, I'm pleased to have a panel that is going to be moderated by Joseph Selwood of Revere, and is going to be also accompanied by Maria Paula Catuccio, who is the head of ESG strategy for Brazil in Santander's investment bank from the equity research team. We have Mark Kaplan, who is a founder and partner in Invisible and was also the ex-global vice president of sustainable solutions for Unilever. We also have the pleasure of having Rebecca Bravo Varejo, who's the head of finance at Cultivo Land, which is an innovative fintech startup focused on how is it that investors can participate in rejuvenation of land and the global ecosystem. This sequence of Economics of Change will discuss the power of sustainable investing, driving long-term growth and positive social impact, because we believe that having a more sustainable economy can be a catalyst for growth, especially as we looking through significant demographic, social, health, and other macro impacts, mostly also driven by technology. We are going to discuss a little bit about the economic challenges of 2022 in this edition of the Economics of Change, and we'll talk about how is it that all of us can try to figure out models that can accelerate our business so that we can preserve the environment, improve the contribution towards a healthy coexistence. I would like to remind you that you would have the opportunity to participate and interact with me and our panelists through the chat function. So please familiarize yourself with the chat function. You can also select the language that you can hear. We have simultaneous translation in Portuguese and in English. And we invite you to send your questions and comments through chat so that we will be able to respond to that. Without further ado, I would like to present Joe Selwood, who is going to be our moderator, so that he can talk us through the panel. Before, I want to introduce Joe briefly. Joe is the director and founding partner of Revere and has over 20 years experience in strategic consulting with governments, businesses, and NGOs, developing cross-sector solutions to global sustainability challenges. Joe leads Revere's team in North and South America. In the last 5 years, Joe has led the development of an online platform for investors and banks to assess company practices for achieving deforestation-free supply in the operation of companies in the global food sector. Joe is also working with international partners to develop a technology-enabled, traceable solution from raw material to the final consumer for multiple commodities. Previously, Joe worked in the financial services sector and helped Citibank establish its first microfinance program in Vietnam. Joe has also worked across the world and previously worked at the Inter-American Development Bank, the Inter-American Foundation, the U.S. Environmental Protection Agency, U.S. Department of Defense, USAID, World Bank, and the IFC. Among other qualifications, Joe holds a master's in economic ecology from the University of Maryland. Joe, thank you so much for moderating this excellent panel. Now you have the phone.
Thank you, Nana. Thank you very much for that introduction and opening. And I'd just like to reinforce everyone, really, as we go along, put your questions into kind of document your questions so we can share those with our panelists. As Nana said, I'm Joe Selwood. So in English for my Brazilian cohorts, that's Benji Madeira, which is a very complicated last name. Selwood for somebody that works a lot in deforestation. But the translation of my name in Brazil is Joey Seworldji. Sometimes my name is pronounced like that. So my name is even better in Brazil and more entertaining in Brazil than it is in my home country, the United States. So it's a pleasure to be here today. As Nana said, I've been working on ESG issues for over 20 years. I've worked extensively in multiple sectors in healthcare, extractives, consumer brands, agriculture, food, and finance quite extensively. And recently, I think because the reason why we're here today, there really has been a boom in the finance sector, especially over the last year, in my perspective, on ESG issues. And we're working extensively with investors and banks in order to assess company performance on ESG issues. And include in that assessment a plan to actually minimize the risk in order to structure engagement between investors and companies. So to start off, I would like to kind of do a round with our panelists of self-introductions. So please tell us a little bit so we can get to know who we're talking to, your name and your position and some of your background and experience relevant to our discussion today. And I'll start with Maria Paula. Maria Paula.
Thank you so much, Joe. So thanks for the invitation. I'm Maria Paula Cantuzio. I'm the head of ESG equity research at Santander Corporate and Investment Banking, covering for the Brazilian market. I have more than 15 years of experience in the financial markets, and the last 4 years I've been working directly with ESG analysis. So I started working with ESG at S&P Global Ratings 4 years ago, and in the last 2 years, I've been covering ESG in the equity research team of Santander with a cross-sector approach. So my role is to understand what companies are doing to engage more with ESG drivers, and also how they can improve it and how the ESG engagement can affect the stock performance of those companies. Thank you, Joe.
Thanks so much, Maria Paula, for being here today. Mark?
Mark Kaplan. Thanks, Joe. I'm founder of Invisible and the co-founder of WholeChain, traceability system. My background, as Mr. Bafour mentioned earlier, previous to Invisible, I led digital for Unilever's Chief Sustainability Office as Global Vice President. In these 5 years, I've had a lot of experience implementing digital solutions to help achieve, broadly speaking, sustainability goals, and more recently referred to as ESG. So have quite a bit of experience actually executing the solutions that we'll be talking about on the ground. Thank you.
Thanks for being here, Mark. And Rebecca?
Thank you, Joe. I'm Rebecca Bravo, and I serve as head of finance in Cultivo. Cultivo is a US-based climate fintech that exists to unlock investment to protect and restore nature at scale. There I execute the company's financial strategy and evaluate, execute, and manage investments in the natural capital asset class. And a little bit of my background, I have 10 years of investment experience. Previous to joining Cultivo, I served as an investment professional at Northgate Capital. $4 billion private equity and venture capital firm based in San Francisco. And prior to that, I worked at Lazard in the investment banking division and in Credit Suisse in the private banking division.
Thank you so much, Rebecca, for being here today, and to all our panelists. So to start, I just wanted to open up with a few observations that I've had over this last year that I think can be important trends going forward in the next couple of years. One, Mark called out, we're talking about ESG. For me, this is sustainability. It's kind of the new terminology of something that many of us have been working on for a long time. Yeah. But 5 potential trends or standouts. The first one, I think any list now, you have to start with COVID and the pandemic. I think, the impact that COVID and the pandemic have had, that non-financial factors that we now call ESG factors they have significant potential to economies and economic actors. I think that's kind of really come to the forefront with the pandemic. I personally have seen kind of a boom in this last year. I'm curious to hear from others on the ESG front, especially from the financial sector. And that might be to, move in order to plug, some of the gaps that the pandemic has exposed, or to better prepare for future shocks now that we see, these non-financial issues that many people have been talking about for a long time, how much of an impact they can have, kind of the investor sector really paying attention. It looks like for the second year in a row, we're on track for record inflows for ESG funds. And I think this is going to strengthen as in the next few decades, we're going to see the largest wealth transfer in our history of, I think it's $30 trillion from baby boomers to millennials. And millennials are likely to have a different perspective and to concentrate more in value-based investments than their grandparents or older parents. A second trend that I see is the S has become bigger. The social element of ESG has become bigger. Again, fallout maybe from the pandemic. It continues to reveal growing weak points in society, wealth concentration, devastated local communities, workforce relationships, the whole essential workers, racial injustice, unequal access to important services like healthcare. This has all become very intense and apparent with the pandemic, and how companies manage these issues in the societies where they operate will determine their long-term survival, I think, livelihood and investability, very much so. Another trend I'd say going forward from here on out, you've got to prove it. Companies have to prove it. So society, I think, is very tired of claims and communication and surface level propaganda. People just don't trust the noise anymore. And so I think a big question in everybody's mind when any kind of company says that they're working on ESG related issues is to prove it. Show me, don't tell me. And that means demonstrating with clear indicators the progress that's being made. And that also means that ESG efforts are going to have to clearly generate value. And this is turning more and more possible with a fourth trend I see is there's a T in ESG, and the T is for technology. So the use of technologies, new approaches, new players that haven't maybe been so involved in solving ESG issues. I really think that we're in the infancy of what technology's impact is going to be to ESG issues. And the application of technology, in my experience, is allowing for new data flows. And that's what we truly need in order to drive performance from the bottom up. So better data, better real world change, better returns, better risk profile, which means better investments. And finally, the last trend that really kind of jumps out for me is I take it that the green bonds market is growing a bit. Maria Paula and I talked about this a little bit before. And as climate change kind of becomes increasingly top of mind, I think this is just going to get stronger. So my quote, any panelist that has other information sources, the ones that I found was the global green bond market, it looks like it's predicted to double in size this year to reach $1 trillion by the end of 22, and they're predicting now $5 trillion by 2025. And so that's significant growth. And I think we're starting to feel that in markets around the world. In regard to climate change specifically, which I think is going to be a big focus, it seems that we need to redesign investment strategies a little. Typically, many strategies are based on historical data and linear models that honestly haven't considered climate change. I remember working on an energy project, less than, maybe 6-7 years ago. And the assumption was zero cost for carbon for the next 30 years because there hasn't been any cost for carbon for the last 30 years. And I think that's kind of crazy in today's environment and context. I think there's signs of large scale repricing on the horizon. So investors should get ready to feel the earth move beneath them once again in the coming years. So I'd be very interested to hear, as we talk from the panelists on if these trends ring true for them, or to hear on new trends that they feel are going to be very strong going forward. So to open up our panel, I'd like to start with Maria Paula, a question to you. We know ESG efforts when they're well done, it improves our lives and improves the world around us. But to be honest, there's been a long history to varying degrees, and we're talking about decades of pushback from the private sector that ESG issues are extraneous to business success. But again, when they're done well, we're talking about improving the operating environment where these companies, operate. And that can mean, again, if it's done well, reduced risks, lower operational costs, license to operate, new markets or clients, innovation, in short, a series of valuable business benefits to the companies. So the question to you is, given our current moment, and you have a long history in this area, what do you think is our current moment in the evolution of ESG efforts? Do you think companies are ready to take ESG seriously? Or do you think some or many companies are still buying time? Kind of how do you read this moment in the movement of ESG factors?
Thank you, Joe. So just one comment here in the list of main drivers you see for ESG right now. I think I would also add that those famous images of the satellites in China and all over the globe during the pandemic showed to everyone how difficult it's going to be to reduce carbon emissions. I mean, we cannot stop the world to reduce emissions. So it showed for everyone, all countries, and also all companies that we do have to take some actions in order to reduce the emissions without stopping the economy so we can reach the Paris Agreement. That would be my comment. And going to your question, I think that we have different degrees of ESG engagement when we're talking about companies. So of course, in Europe, we have a more developed agenda inside companies when it comes to ESG engagement. And then when we go to emerging markets, this is a little bit late. But even in emerging markets, we do have some global companies that are doing an excellent work. I think that globally, we still have to evolve a lot in regards to standardization of data and also to the standardization of an agenda that involves not only companies, but also governance to see how everybody is going to move together and reach the goals, especially of emission reductions and biodiversity preservation. But what I think that companies are seeing much more after the pandemic is how much ESG drivers can impact their economics. So as I was saying in the beginning, the analysis that we do is putting together economic drivers and ESG drivers. And it's so clear how when we are analyzing a company, how ESG factors actually have a clear impact into their economics. So when a company is reducing the use of water, or they are reducing the use of electricity, this is translated into reducing costs. When a company is concerned today with the carbon emissions that it has in the environment, it's telling us that in the future, they're not going to be impacted for a carbon tax or for mandatory carbon purchases, for example. And more than that, when the company is investing in the development of the community that is surrounding its operations, they are also guaranteeing that in the future they will have better skilled people to hire in the surrounding communities. So I always say that ESG is the kind of stuff that is good for everybody, and those last months have been proving us that it has everything to do with economics. So just to mention here, a recent study that I saw from IFC, for example, they analyzed it for 5 years, the companies that had better developed their ESG agendas, and the outcome was that the return on equity of those companies was like more than 200 basis points above those companies that didn't have such a strong ESG agenda. So in the end of the day, ESG is about being good for all, and we have been seeing companies engaging much more, but it's still very hard to put all the companies in only one group and say companies are ready or are not ready. I would say that global companies, even from emerging markets, they are more prepared than those ones that are not global yet. And especially here in Brazil, the smaller companies that are still trying to catch up with their ESG agendas, they're trying to evaluate and measure things inside the company so they can get prepared to the transitioning of a low carbon economy. I think these are the main points that I would like to highlight here.
And just a follow-up question, how is this relevant to the financial sector? Can you tell us some secrets as to how Santander is changing your operation? How is this analysis relevant for financial actors?
Okay. Not everything about ESG is objective. I would say that we do have a lot of subjective stuff, but there's a lot of economics that is evolved with ESG. So as I told you, if companies are reducing water use, electricity use, this is translated into a reduction in costs. If they have lower turnover, this is also translated into reduced costs. And more than that, when we are doing the valuation of a company, there is the perpetuity growth that we use in our evaluation. And we cannot avoid how much the transition to a low carbon economy is embedded today into the perpetuity growth of a company. You cannot consider that a company that is issuing tons and tons of carbon and is not taking any actions on it, that it's going to be treated or evaluated the same way that a company that is trying to apply some measures to reduce that and be more aligned with a transition to a low carbon economy. So there are different ways that we analyze the financial impact of ESG. You have costs, you have the growth in perpetuity, and you also have the discount rate of the valuation that we use for companies that is also impacted by ESG drivers nowadays.
Interesting to hear that this is being taken into account. Mark, I'd like to hear a little bit about kind of how to achieve, this in practice with companies. I understand that you're involved in some very interesting progress at Whole Chain with the practical application of technology to address some of the issues that Maria Paula has mentioned. So can you tell us a little bit about those efforts and how do you feel technology and its application will impact the way we approach ESG issues?
Yeah, absolutely. Thanks, Joe. And thank you, Maria Paula. Technology really enables businesses to better measure and impact their financial footprint with things like sensor technology, to better and satellite technologies to help monitor their emissions. It helps monitor things like deforestation that they oftentimes might not have visibility that's happening at the initial tiers of their supply chains. Acidification is another use case that can be monitored, measured, and then it helps inform the people who run the company to make interventions in their supply chains for improvements. Also, to improve social impacts, tools like digital payments and digital identity help achieve financial inclusion and financial equity in their supply chains as well. So I also want to highlight that technologies are not always digital. So things like eco-friendly packaging is a good example that's actually cheaper than styrofoam to use as a coolant. And so there is this perception that technologies are always digital, but they're not. And some physical technologies can also help make quite a considerable impact, like a recyclable coffee cup as an example. Also, technologies like mobile communications and blockchain help achieve more digital inclusion. So more trustworthy data collection and data sharing networks between businesses, governments, and people. And as you mentioned, Joe, financial markets have no consideration for climate change, but commodities markets pricing don't consider slave and unfair wages in their supply chains either. So I think that disruption is going to come in many ways as transparency and traceability become not just a trend, but an expectation of companies. So some of the other approaches that we've taken, so we have digitized entire supply chains at this point. And through the pandemic, it helped us achieve things like reducing waste in supply chains that we oversee and manage, because we've been able to identify points along supply chains where commodities are. And then when there were shocks in the supply chain through the pandemic, I just refer back to that given it's so timely. We've had outbreaks in supply chains that we've been overseeing, and we were able to intervene, redirect raw materials that were on their way to a packing facility that had an outbreak, redirect it to a co-packer and maintain in stock. That also helped reduce the waste of that food being thrown out because it was highly perishable. And it also helps us remotely manage interventions like government health inspections and better manage imports. So the delays that we're hearing about in supply chains can be mitigated. From a governance perspective, businesses and governments are able to create policies to facilitate and reward use of technology. Also, standardizing key data elements, as Maria Paula mentioned, can help synthesize these inputs and better measure impact across an entire sector rather than just proprietary to any one company, and ultimately better enable consumers to make informed decisions in line with their values.
So it sounds like you're managing supply chains rather than operations, individual operations.
It feels like that. It feels like that for sure.
And how is this new look and application relevant to the financial sector and financial actors and banks, et cetera?
So we're able to report this data out to the financial industry. Now that's up to the decision of the people who run those companies, granted, because technology doesn't operate autonomously yet to that degree where it automatically shares data out to the broader markets. But it definitely enables financial institutions to hold customers accountable to their actions and practices, because to your point earlier, the risk profiles are so dramatically heightened at this point, from a climate perspective, from a social perspective. I mean, you know, banks are brands as well, and they don't want to be seen lending to abusers of human rights and supply chains or abusers of the environment. So I think that from a financial markets perspective, they are the best suited to actually force this change. I think at this point, the brand of government, just broadly speaking, has eroded even more than the corporate brand, just given by the state of the world affairs and so-called leadership. So yeah, I think the financial markets can use new technologies, especially digital technologies, to improve the rigor of data sharing, and really force a lot of disclosure and transparency.
Banks, investors, the financial sector have skin in the game, are involved in this risk, but they're removed enough maybe to take a look at this objectively.
Joe, if I may, let me try to jump in here, if I may. I think I wanna touch a little bit upon what Maria Paula said, and maybe even try to connect that a little bit with Mark, which is that it seems to me that yes, the financial sector being sort of the heart of the economy in terms of moving capital around, is got a strong role to play in terms of how we can get to a better place in terms of ESG and so forth. But I'm a little bit curious about how that can actually happen, when it seems to me from what Maria is talking about, that the issue is less about whether there's a benefit or not a benefit to having ESG. I think most people will probably agree that there's a benefit, using less water, investing in the community, et cetera, et cetera. But it seems to me the issue is really about time, right? Depending on how long I have in terms of how I'm being judged, and I'm talking about a returns perspective, I can be more impactful than not, right? So if time becomes the big issue in terms of how much time I can be given to be able to execute, and by the way, a lot of these things actually take time to do, how are we going to reconcile that to a financial market that is always relative return based on some index? That's one point, right? So all the actors in the financial services, most of them that are managing capital, they are being judged vis-a-vis an index, right? So that's one thing. And so it's almost like ESG is nice, but just give me, 500 basis points over the S&P or the Bovespa or whatever, and then after that we can talk about your ESG. So that's one limitation, I think. The other limitation is, how are we going to be able to get the right incentives to companies when the boards of these companies, as well as the managers of these companies, have to, on a quarterly basis, deliver a certain performance? It just seems like the measurement approach and the incentive approach is without odds with what we need has to happen for ESG to really show the value that everybody agrees that it has. And so against that background, I'll be curious to hear what Maria and Mark and maybe Rebecca as well. How do we square this? How do we square the measurement and the incentive approach in the financial services, which is really short-term oriented, with what is invariably a medium to long-term proposition, which is, these ESG concepts, for them to really reflect in the value? How do we square that?
Well, this is very similar to a question I had ready for Rebecca. I see her smiling as you're asking the question. This question's too hard for me, so I'd like to hear from you, Rebecca. We're in tough financial times right now. At the same time that these issues are happening, why is it more important than ever, and how do you respond to Nana's questions?
Sure. Well, to start first with Nana's question, I would say that the allocation of investment money towards the conservation and restoration of natural capital is a new and emerging investment trend known as natural capital finance. And that is different from ESG screening-based sustainable finance, which is a process to capture non-financial factors of an investment, such as resource efficiency, pollution mitigation, and policies on gender diversity, among others. The natural capital finance market is growing on a global level, creating a need for projects and technology to help manage negative and positive externalities, such as carbon emissions, water use, and impact on biodiversity. I consider that significant value potential exists in projects that can fulfill this demand. And without a doubt, that high quality projects with proven market acceptance provide the most interesting value opportunities in this sector. As consumers, policymakers, and investors are realizing the need to measure and account for all externalities that the production of a good or a service involves, the distinction between financial and environmental and social returns is breaking down. And as all externalities are included in the cost of capital, activities previously considered to be realm of non-for-profit organizations, such as mangrove restoration for carbon capture, or water conservation via efficiency improvements, and even preservation of biodiversity, are becoming both profitable and earning above market rate returns. To put this in context, nonprofit nature conservation organizations, flows from governments, private philanthropic organizations, and NGOs are currently estimated at 52 to 143 billion per annum versus annual funding needs of 300 to 400 billion per annum. Similarly, wide-ranging estimates exist regarding the cost of reaching net zero emissions. In the last 2 years, we have also seen large asset owners, such as public pension funds and university endowments, seeking to deploy capital into investments that combine financial return with measurable social and environmental impact, including contributions to SDG targets. These are some of the dynamics that have started to create this attractive investment environment, and are the reason natural capital investments will be sustained and intensified over the next decades, creating a multi-billion global market. Additionally, and another thing attractive about investing in natural capital related indices, it's that they have shown a small and in some cases negative correlation to both bonds and equities, as measured by US 10-year Treasury bond or the MSCI World Index. In my view, financial returns from both the natural capital asset and monetizable natural capital ecoservice benefits are also correlated from a broader economic cycle, and are influenced by highly idiosyncratic factors such as weather, climate change, and also politics.
But let me maybe push back a little bit, Rebecca. So I think what I'm hearing you say is, look, maybe for regular investments and so forth, and the questions that I asked about time and return and so forth, okay, maybe it's applicable there, but maybe correct me if I'm wrong, you are saying that for natural capital investment, people are already investing for something that they know that it may take time and it's a specific thing and it's growing. Okay, I can buy that, but it still doesn't answer the question for all the other investments that are not natural capital, where there is a challenge between returns and time, right? In natural capital, okay, I get it. You want to invest in natural capital, you already know that it's going to take time for whether reforestation or eco biodiversity, and so that may be fine, that the returns is baked into it. But that, I don't know what the percentages are, but I would imagine that natural capital investing, as much as it's growing, is probably less than 5% of all the investments that people make. So the broader question within the investment community in terms of how is it that we are squaring away the issue of measuring on a quarterly basis with the issue of the time required to actually deliver these things. Maybe natural capital, that's not an issue because it takes time and everybody knows it, but everywhere else it is an issue, I think. So what is there anything that you want to touch in on that?
Mark, go ahead, Rebecca.
No, thank you. And I think this additional comment from Nana relates to the question that you initially made, which is why is important more than ever, right? And I think, Nana, that the natural capital is in decline. And if we do not regenerate it, we are undermining one of the key pillars of the economic growth. By neglecting it so much that irreversible thresholds regarding climate change, biodiversity loss, soil degradation are among others, we are in a permanent dent in the productive capacity of our global economy. And estimates vary, but the cost of climate change alone is predicted to reach between 54 to 69 trillion globally by 2100. Based on the average global temperature rising of 1.5 to 2 degrees Celsius above pre-industrial levels. And on a non-equivalent basis is similar to the conclusions of other studies, which put the potential damage to growth of 0.67% in annual global GDP by 2050, or the equivalent to an annual loss of $479 billion. Losses would stem from smaller crop yields, fish catches, a greater exposure to floods and other natural disasters, such as increased frequency in tropical cyclones, droughts, and wildfires. And according to one of the bleaker estimates, as we reach an irreversible tipping point for nature and climate, over half of the global GDP, or up to 44 trillion, is potentially under threat from nature loss, unless close to 2.7 trillion per annum is spent on nature-positive investments in sustainable food production, infrastructure, systems, and others. The OECD estimates that 7 trillion per annum of sustainability-focused investments is needed in order to avert the damage to the planet.
So it seems that in natural capital, I think we have kind of a competing investment. Mark or Maria Paula, would you like to kind of respond to Nana's provocations of how we're
Sure.
how?
I'll go second.
Okay, Maria Paula.
So tick is clocking, right? I agree with Nana, and that companies are always demanded by markets to deliver quarterly results, but we cannot forget that behind those quarterly results, there is a long-term strategy. And ESG has been part of this long-term strategy. So companies, they have been engaging with the United Nations 2030 agenda of commitments, with the UN Sustainable Development Goals, with the Paris Agreement of reducing emissions by 2050. And we have been seeing more and more the boards of the companies engaged with those topics, and actually ESG topics impacting in the compensation of the C-level of companies. And this is of course the reflection of a much broader agenda. So if we have countries assuming commitments of reducing their carbon footprint, that will reflect directly on the financial system and of course on companies. So we have just seen the COP26, in which more than 400 financial institutions, they have committed to reduce their investment and become net zero by 2050. And those financial institutions, they are responsible for more than 40% of the financial assets that we have globally. So besides the pressure that we see from governments, we see the private sector, especially banks and pension funds, that they are leading this agenda. And of course, because banks, they have exposure to all the other sectors through their business, this means that if those businesses, if they don't adapt, they are not going to be financed anymore by the financial markets, or they are not going to receive investments anymore from the large global funds. So I think it is a chain, everything is connected. And we actually have been seeing companies looking more to the long-term strategy and putting ESG into their long-term strategy than only looking to quarterly results. And more than that, we cannot forget that the main agreement that we have in regards to ESG investments is the PRI, which is the Principle for Responsible Investments, and investors responsible for 90% of the global AUM, they are signatories of that agreement. And what they commit when they sign the agreement is that they will have at least 50% of their AUM invested in an ESG perspective. Right now, the statistics show that we are that we have ESG investments that represent 30% of the AUM. So by 2023, this is going to be up to 50%. And after 2023, we expect that this is going to go up even more, maybe reaching 70% or 90%. I don't know if I was clear, but I see investors engaging in increasing the ESG stake of their investments, even when they are not pressured by any government. So I think this is really important, the private engagement that we have been seeing in the market.
So institutional investors will give some space for companies to do this. It just occurred to me, Mark, I think you were at Unilever when a famous CEO stopped doing his quarterly reports. I don't know how that worked out.
It seems to be doing pretty well still.
Okay.
They, I don't see them struggling to sell ice cream or soap any.
And Unilever continues to have kind of that long-term view of not reporting quarterly now.
I'll just say that it was the most inspiring experience of my career that led me to create my current company. And I only am out of the business there because my father got sick and I moved back to the US. So I think Unilever is a great example of companies that embed sustainability as corporate culture and not just as some, loose motto or something. It's truly ingrained in the day-to-day operations of the business. But to answer to address Mr. Bafour's point earlier about time, the UN set a goal of 2030. I see companies now patting themselves on the back about 2050. The reality is that regardless of the lack of motivation of companies to operationalize their claims, nature is not going to listen to them. And so what we did as an action, not just talking, we created our own food company to prove the concept of traceability. So in addition to whole chain, we operate 15 seafood supply chains, and we committed to price transparency up front in addition to traceability. So now let me give you the timeline here for achieving traceability in supply chains for wild animals that swim underwater as a relative complexity to land-based supply chains. We transformed 15 supply chains from opaque to fully traceable in less than a year. Those were from 6 different countries, most in the global south, only 2 of them in the north, across every continent, imported, processed, so on and so forth. And it was possible to be done, and we reduced the cost of goods to the buyer and improved the compensation to the producer because price transparency exposed areas of opportunity for efficiencies along the supply chains. So we consolidated those supply chains, removed the value extracting actors, which were typically the tier 1 suppliers who were charging abusive margins for just putting already processed fish in a bag. And we redistributed those savings as the cost reduction to the buyer and the improvement in compensation to the producer level. So right there, you have three impacts. One, an efficiency in the supply chain that yielded immediate financial returns to both sides. The improvement on social impact by improving the compensation to the producer. What that yielded was more resilience in our supply chains to maintain in stock. Another immediate de-risking of our profile as a company and our buyers' profile. And then three, from a food access standpoint, that added resilience enables nutrition to be more accessible to more people in the market. So that drove sales increase by over 30% across the entire product line through 2020. And that's immediate. That's a 2-year horizon. All it took was our commitment to do it, and we actually did it. We didn't just talk about it. And so as far as timelines are concerned, I struggle with these exceedingly long-termist outlooks because they're essentially a passing of accountability to execute by that leadership. And frankly, it's just cowardice of people in charge standing behind a brand and saying it's the company. But the company is run by individuals who can make the decision and force the operations. Unilever has done this before at their scale. And what I'm describing is a very large supply chain that feeds over 50 grocers in the United States. It isn't the overblown blockchain pilots that we read so much about that are actually very small scale, but really just a greenwash for not taking real action. I have to just say that it, as a citizen of the world, I find it offensive when companies are congratulated for failing to achieve 2030 and kicking the can down the road 20 years as if the world is going to stop. So I appreciate Maria Paula's point earlier about you can't stop the world to improve emissions. You also can't stop the world from eroding while corporations get their backbone.
Well, it's interesting, Mark. You should say that, but it's a classic case of mirage. Why the time frame, right? Because everybody knows what a mirage is, right? It's far away. The further it is, the more beautiful it is until you get closer, right? And then it disappears. So companies are practicing that in practice. But I want to see if I can maybe add some context to what you're saying, going back to what Rebecca was saying in terms of externalities. And perhaps Maria can also chime in as a research analyst. I do think that the concept of factoring in externalities can be a way that people can be forced, even in a short-term return perspective, to decide. The question, though, is that really happening? And if it's happening, is it happening in a more concerted effort? So, for example, I'll give you an example. When you look at the valuation of Facebook, and admittedly, it's not going as fast as Tesla, but you look at the valuation of Uber, for example. Are we really factoring in the externalities of having millions of people working 15 hours a day to make, I don't know, $20,000 a year, right? From a Uber perspective, I doubt that externality is being captured. If you look at the valuation for Facebook, how are we pricing in this distorted nature that we have on our politics and our sense of self and the impact on young people about their emotional balance? How is that being priced in? Because this is a real externality, right? So I do think that Rebecca had a point that externalities will help the decision making, to mark your point, probably force the choices to be made sooner rather than later. But and maybe here Maria can chime in, but is it really happening, and what needs to happen so that we really do capture? Because some of these externalities we all know, right? Everybody's aware of it and we all complain about it, but I don't think it's making a difference to the investors that are investing in this. Their returns just keep, if you look at the Dow or the NASDAQ, or pick any index you like in the last 24 months, most of them are up 15, 20%. So where is these externalities?
And is the answer, it's a question of leadership and, you know, in order to incorporate something like that, to take on Uber, like, hey, you know, but not to pick on specifically them, but
I was just,
alternatives to how to do it better, say taking, you know, I'm sure, you know, Mark's example, their competitors for that kind of, you know, fish, et cetera, you know, position what is being done in real impacts against the competitors and see whether markets or investors respond. You know, what I hear from Mark is a key ingredient is leadership in order
all
to
right.
Yes.
that happen. Go ahead, Mark.
No, I was just absolutely. The key ingredient is leadership. And I think all the examples that Mr. Before just shared all have very polarizing leaders. I mean, Uber, Facebook, I mean, these are poster childs of just people who behave at work in ways they would never allow their children to behave at home. And I think that that benchmark is just something that's overlooked in leaders. So, you know, if you, I'll speak from now personally from our supply chains, because I try not to make assumptions like, I don't know how Facebook is valued. To me, I struggle with valuing something so much that no one would really pay for, as an example. But in seafood and in other commodities, what I struggle with is the lack of recognition that the asset is the natural resource and the overvaluation of the demand side of the supply chain with a devaluation of the resource that that supply chain requires to operate. So valuing machines that cut fish more than the fish itself needs to be reconciled.
And just not to cut you off, but Mark, even
No,
more
please.
distortive, the less we value the fish, the more the machines that cut the fish are valued, right?
Totally. It's so paradoxical. I can't, it's a self-defeating business model, essentially. And so that in itself, I feel like is an area of opportunity for correction that the markets could actually influence quite tactically.
But those examples need to start popping up, et cetera, to have those options.
And I think it goes to what, I mean, everyone has spoken about in terms of as these resources become more scarce, reality sets in. And the scary part of this is without the alignment, like I prior to Unilever, I worked in a project for the US Department of State training small scale fishers how to use mobile technology. And one of the thesis behind that project was food insecurity creates social instability and is a political risk. As food, I think that food and water and the scarcity of it is going to drive a scary social response as it relates to societies of people that are displaced and lack basic needs. And hopefully leadership can recognize this and make the interventions in markets to value those natural resources that are necessary for stable societies. I don't have the experience on that like Maria Paula or Mr. Before have in their expertise in the financial markets on how that can be done. But I do know that the natural resources of these supply chains need to be valued more than the real commodity, which is you can replace a machine that cuts a fish, but you can't replace fish stocks that are completely depleted.
Rebecca, Maria Paula, would you like to comment on this?
Sure. I think that what you guys were discussing in the beginning of the event, especially you, Joel, that 2021 was important for the social letter of ESG is very much true. Because what we see so far is that in the financial markets, most part of the concerns are concentrated into emissions, diversity, and water is beginning to gain more attention, as well as circular economy. So I think we are in the beginning of an agenda that has a lot to evolve, and specifically the social part has a lot to evolve, not only in emerging markets, but I would say all over the globe. And that's what we hope to see in the coming years. And of course, I totally agree with Nana that all the drivers that he pointed out in regards to Facebook and also Uber, it's something that has to impact a lot into the valuation of companies like this.
And the availability of these natural resources have tremendous social impacts. I think that kind of like what's the cause and what's the symptom. I think, you know, we're going to see more and more that the social impacts where the cause is availability of the environmental resources. Rebecca, would you like to comment on that specifically?
Yeah, I also completely agree. The negative externalities are not recorded on a corporate balance sheet and are not included in the cost of production of a good or a service. And also the positive externalities are also not included and valued. And the positive externalities, I mean atmospheric CO2 that turns into oxygen. And so this means that this is undervalued in the financial decision makings. But I do believe that regulation to force business models with negative externalities to adapt are ratcheting up. And a very clear example are the taxes that are being imposed on heavy emitters of carbon. And sequestering carbon becomes a monetizable asset. So I think this is evolving slowly, but we're going to see this evolve in a more rapid way in the short term, in the following years. Similarly, water saving technologies in agriculture, for example, allow efficient growers to sell an untapped portion of their quotas to more excessive users. And another example is that landowners are being paid for promoting biodiversity, which in turn will increase the resilience of a wider ecosystem. So it's not being accounted right now, but I really think this is going to be changing, and it's going to be changing for all companies.
Yeah, on the regulation aspect, you know, kind of an opinion of, are you seeing that as well? Do you agree with that movement is happening, and that will be a factor because that changes kind of the whole risk profile, et cetera, for companies if it's becoming mandatory? What are your takes on that?
Yeah, I definitely see that. I think regulation is being changed. Mostly it's starting on the developed countries. For example, UK has a very strong biodiversity, water, and carbon offset policies. The US is catching up. And I think it's going to begin also in the rest of the countries.
Mark, Maria Paula, do you agree? Do you see that as well?
I do. The US is the FDA just implemented a new update to the Food Safety Modernization Act, just in the midst of COVID, that will require traceability across 13 high-risk food categories. I mean, these are large categories ranging from seafood to produce to cheese. So it is happening here.
And Maria Paula, in Brazil, what's your read? Given, you know, we have a kind of a different scenario with, you know, the government support.
I definitely agree with Rebecca that the UK is a step ahead regarding the rest of the world when it comes to regulation concerning sustainability. Here in Brazil, we see the central bank as a pioneer when it comes to ESG regulation. So beginning in 2014, the central bank asked for pension funds to disclose how their investments have been impacting have been impacting from an environmental point of view. And now beginning 2022, banks will be demanded to disclose through the TCFD how their operations are exposed to the most pollutant sectors or to the most impactful sectors from an environmental point of view. And we see that our securities exchange is also trying to see what are the best way to make companies align with what bankings have been doing. And I see things evolving, but of course we are an emerging market and we are still a step back when it comes to developed countries.
And go ahead, Mark, do you have a comment?
Yeah, I was just going to say, because we're speaking to a financial audience here, and this is as a question, a comment in the form of a question, do offsets just allow companies to buy their way into polluting more? Is it just like a hall pass to keep polluting?
So as I was saying, Mark, we have very different behaviors among the companies here in Brazil. So when it comes to a global, a large company that is listed in the stock exchange, for example, I do see that they are first trying to reduce their carbon footprint and then study ways to offset the rest of it. So let's say that the engagement is more on the reduction side than on the offset part. But for example, when you talk about natural resources, everything that we see here in the preservation of forests, it's coming from the private sector. So we have a very increasing voluntary carbon market here in Brazil that is supported by the private sector, but not always. Sometimes the company supports those projects, but it's not always because it's going to have an offset mechanism in the end of it. It's more because of the reputational side. They want to link their brand to a project that is focused on reforestation. I don't know if that was clear, but that's what we have been seeing. But of course, when it comes to the oil and sector, the oil and sector here in Brazil, we do see they relying too much that some kind of carbon mechanism, some kind of carbon sequestering mechanism is going to be developed, and they are not going to have to reduce their operations in this segment. We do see some companies in this sector relying too much on this type of stuff.
I think
In many cases, it's going to come down to what's going on along the whole supply chain, Mark, and maybe talk a little bit about the activity that you're involved in Brazil, and that might be relevant. The kinds of investments that Rebecca is talking about need to happen kind of all along the supply chain with these different actors, not necessarily just at headquarters. So maybe you could talk a little bit about what you're doing in Brazil currently.
Yeah, so we are working with Rever and others on tracing soy in the Amazon. And a part of this is to establish a real-time connection to not just talk about deforestation, but have evidence of preventing deforestation and reclamation of the rainforest. And by doing so at source, we're then able to capture the events that are taking place at that location and at that step of the supply chain, and then carry it forward to the next steps along the chain, all the way through to production. So we would be able to have the output of a holistic impact report of an end good that started with soy or beef or leather that is sourced from the Amazon. And if you imagine that supply chain as it goes, it's accumulating event data that will then paint the picture of every step from starting with the provenance of the commodity on a lot basis through to the processing of it, which is often overlooked in reporting, is the processing of an outputted good. But it will ultimately lead to enabling the buyers of these commodities to present to their consumers the actions that they took and the story of their entire supply chain, providing them the commercial reward for making those investments in their supply chains. So, the incentive in that scenario is that the consumer brand is going to have a verified claim that they are absolutely supporting programs and implementing improvements to prevent deforestation in their supply chains.
And I imagine that same information is relevant for investors,
Absolutely.
et cetera.
Well, and further, it can also become a proof of concept. Something that we're encouraging a lot of our partners to do is take a leadership position right now, because it is such an emerging trend, and set the standard. If companies take the first step, and this is something I learned in the past, is if companies are leaders, they set the standard for their industry and their advocacy becomes the norm. So
For the better or for the worse.
exactly. That's where I was just tripping over myself. Indeed. And so it is such an opportunistic moment in history right now, for those companies to step forward and take the actions that we're talking about here and set themselves up for hopefully a decade of success coming.
I do think
And I
that,
saw you jump in out of your chair again.
yeah, no, look, I do think there's an element, there's a demographic and technology element that is going on that I am not sure that all of us, and I'm talking on a macro perspective, are giving enough credit to the capacity for this element to make a big difference. And what do I mean by that? I'm talking about the ability of emerging markets to be big providers of the talent that are going to be used to drive the economy going forward, and in technology, in creative arts, and all the services that are gonna be happening. I had a conversation. A very good friend of mine is the guy that pioneered the metaverse 30 years ago. It's a guy by the name of Charlie Fink. Okay, I don't know if any of you know Charlie, but he's a columnist for Forbes now. And so when Facebook went out with their new name, Meta, I sent him an email and I said, Charlie, shouldn't these guys be paying you something? You've been talking about this for 30 years, right? So anyways, I get on the phone with him and I said, well, what do you think? And he said, well, it's funny because, of course, he's been talking about it for 30 years. He's got the books on this. Is Charlie Fink's Metaverse. For those that are interested, that's the name of the book. It's in 2 editions. And he said something that's very interesting. He said, one of the things that is going to happen, and that got me thinking as a technology entrepreneur, he said, one of the things that is happening is the capacity for knowledge to be significantly distributed. And that being the case, emerging markets, which is where demographically speaking, the young talent are, that's going to be where they're going to be providing this kind of knowledge base. And so what he said is what we are going to see is we're going to see a repricing of labor costs from the developed markets to the developed markets. And that comes with 2 important trends. One, it's going to come from a part of the world which, for lack of a better word, has not yet been contaminated with the way in which the economic models have been for the last 50 years. That's one point. The second point is going to be that population seems to be a little bit more aware of the need for equilibrium and balance and the focus on ESG. And so when that becomes a much bigger force and it starts permeating corporates, I think we're going to see a more faster, more radical shift than perhaps we think. The fact of the matter is that businesses never lead anything. They always follow, right? the community leads, and then they jump on. And so, they're always catching up, because why would you, when you are enjoying the status quo, why would you change, right? So that's something that I just wanted to bring. And we see that in our business from a technology perspective, just how much the fight for talent is becoming such that now everybody's going around the world. In fact, from a US and European perspective, Latin America has become where people are looking now for predominantly technology talent, because it's the market that's got the most available talent that can quickly get access to the knowledge to be able to provide. And so that's a dynamic that, I think we're not paying enough attention to, but that could be a significant catalyst for the type of things that we all believe should be happening.
Yeah, I mean, we see this happening in our projects in soy, and also the question of deforestation in Brazil. It's going to be solved in Brazil, by Brazilians. In the projects that we're working on, we're using technology, we're using whole chain, et cetera, but it's people on the ground. I was just in the field and talking to people on the ground that have the deep understanding of how to restore these areas. And it's basically enabling them and getting the right incentive to the right person at the right time, which technology enables. But it's that person with the local knowledge being incentivized to actually put that solution into practice that is going to make the change. And, in fact, we need to stop deforestation in this area for the whole world. Stopping deforestation that's already been deforested in the United States isn't going to solve the problem. That has to happen in Brazil. Mark, would you like to compliment?
Yeah, Joe, and I just wanted to add to that point, and specifically to the soy project we've been collaborating on in Brazil. I mean, Whole Chain is hiring Brazilian developers to work on that, because to your point, and I'll extrapolate this to some of the points that were brought up earlier about the vast amounts of money that are being invested into Western NGOs to solve things in the global South. We believe in, and this is also true for the project I talked about earlier from Indonesian fishers, is if it isn't solved locally, it won't progress. The vast amount of funds that are invested in NGOs from the global North often get spent in bloated salaries and business class travel. I mean, it's borderline. I mean, I say this kind of exaggeratingly, but it's criminal, because the money gets wasted and it doesn't actually make the impact. But to your point, investing in local technology development aligns to the sensibilities and the cultural realities of the people who use them. So it's everything from scrolling a user experience on a Android smartphone horizontally versus vertically, which was input that we got from small scale fishers that we worked with in a collaborative manner, to the capabilities of satellite monitoring and what they provide as data outputs that oftentimes are perceived by NGOs and so-called experts from the North who speak to and about the global South, but don't actually have that, aren't actually from there. So yeah, thank you.
So before we open it up to chat questions and stuff, I just wanted to do one round of like a general question of what do you think the biggest trends are? What do you think is going to be the biggest thing in the next couple of years? I put out a couple there, but I'd like to hear from scratch from the panelists. What do you think the biggest trend will be? I'll start with Maria Paula again. What do you think is going to be the biggest trend in the next couple of years?
I see two sides of it. The first one is that how can you pull data related to sustainability stuff from companies? So I see a lot of people trying to develop automatized tools that can pull this data so we can analyze the ESG engagement of companies And of course, here we are putting aside if we think that ESG is more qualitative than quantitative, because we do have to have tools that are able to do a more massified analysis when it comes to ESG data. And the second one, it relates to technologies that can be able to help economies in the transition to a low carbon economy. And in this sense, I think I'm going to say the obvious here, which is how can we work better with carbon sequestration mechanisms, or how can we storage energy? Is it going to be lithium that is going to help us, or the new metal that everyone is talking about, especially here in emerging market, which is niobium. So these are the main points that I see when it comes to technology. And of course, small stuffs like mechanisms that you can develop to reduce the electricity use, the air conditioner use inside companies. And I would say these are the main trends that I hear in my day-to-day work.
Rebecca, what do you see as the big trend for the next couple of years?
I think there are many examples of new technology that are having a very positive impact on sustainability, such as carbon captures and storage, accessible renewable energies, electric transport, cheap energy, among many other things. But going back to the natural capital thing, I think that what is going to be happening on the following years is investment into nature, investment into restoration, investment into conservation, and not only from financial institutions, but also from governments and corporates. And I think that is the trend that we're going to be seeing.
Yeah, especially since we've passed the threshold, regeneration and restoration are going to have to be part of the solution.
Exactly.
Since we've already shot. Mark?
To that point, the trends I see are more passive technologies like satellite monitoring being used that busted the Chinese ghost illegal fishing fleet, and because those can really help provide broader and more passive and more precise monitoring, where human intervention is more irregular in terms of its submission of data, and it's too susceptible to error. And I think another trend is going to be just more broadly, more social unrest about income inequality, abusive working conditions, and climate related impacts is exposing the mistreatment of workers. I think that's going to become a sadly regular occurrence that's going to force more use of measurable payment tools like digital payments, digital identity. Ultimately, the digitization of supply chains, I think, is going to be a necessity for stability.
Yeah, I definitely think social unrest. I think that many people don't know that a lot of immigration that's going on right now is climate related already. I think that that's the kind of thing they kind of think of it as, oh, it's just the same thing it's always been for the last 30 years, and it's clearly not. Nana, what do you feel are the biggest trends, and also after that, any kind of comments coming from the chat?
Yeah, sure. So look, there's a part of me that looks at the glass as half full, and I'll talk a little bit about it. And unfortunately, there's a part of me that looks at the glass as half empty. So since we're in the sharing what I'll share both. So on the part that I think I see as positive, or at least I would like to see as positive, I do believe that considering more and more externalities, both positive and negative, when we think about things, not just companies, but in general, that type of more comprehensive view is going to be more and more in vogue, because I think the generation, millennials and younger, are needing that. They are doing that type of balancing. So thinking about externalities, I think, are going to be very, very important. The second thing that I do think that is going to be more and more prevalent is our capacity to really skill people quickly. There is a shortage of white collar employees around the world. It's not just in software development. it's in accountants, it's in lawyers, there's that shortage. And I do think that on the flip side, there's a huge amount of people that are not working, right? Or don't want to work for whatever the reason is. And some people in certain parts of the world don't have the opportunity to work. You know, when you have countries with 30% unemployment level and so forth, and then you have other countries where people just don't want to be in the labor force anymore. It seems to me that there has to be a way, and it's beginning to happen, where we're going to find a way to scale up more and more people very quickly and bring in people that have historically been outside the periphery. And so at the center, so we're talking about, you know, racial minorities, women, you know, disabilities, et cetera, indigenous. So that's a trend that I think is going to take more and more force in terms of that positive thing. And then I think that the third trend is going to be a much more of I don't want to use the word radical, but I do think that there's going to be a more of a higher bar that the consuming public is going to place on corporates. And so that I think is going to be more and more. I think companies are going to be required to do more than just talk and have nice, you know, PR propaganda. So this is on the positive side. On the negative side, unfortunately, I just see more of a distorted socio-political environment, which is mostly driven by money and is driven by, you know, the entrenched incumbents. I do think that the distortive nature of lobbying and all this other stuff is such that, you know, most people, they're busy working, they're too tired, they're taking care of their kids, and it's very difficult to fight against the grain, right? And so by its very nature, the folks with the bigger pocketbooks end up having the bigger voices. And I don't think that's going to stop anytime soon, unfortunately. So that's kind of how I think about, you know, how these, you know, the trends that I see in the next 5 years or so.
Just a comment on the externalities is, I think what would be great to see is for some leading companies with leadership to turn externalities into competitive advantage. And so if they're able to capture externalities and really work on them, you know, as some of the examples that Mark has pointed out, then all of a sudden that can be a competitive advantage for them, of saying, hey, these externalities, I'm treating them, these are the impacts and results that I'm getting. You know, more people should be doing it like I'm doing it. And I think there are, in many of these sectors, there are a few big actors, and it's a question of one of those big actors in that segment really taking this on and solving it. And then all of a sudden, what was a problem, externalities, becomes an advantage against the others. So I think that's the pathway for that to happen. Then I want to check if there are any questions on our chat that are popping up that you'd like to share and share with our panelists.
Yeah, there's two main questions that popped up, and I think we touched on some of them, but I'll still go through them anyways. And this is applicable to any of the panelists. So the first question was, what was the effect, at least as far as people can see, of COVID-19, the pandemic on society? So that's one question. And then the second question is, you know, what do folks think about progress in terms of how can we continue to make progress in the growth of sustainable investing? So those are two questions that, you know, I think we answered some of them, but I would like to put them forth directly to everybody.
Any takers?
Sure.
Hi, Mark.
I mean, someone's got to go first. So the connection broke up a little bit. It was the effect of COVID on sustainability.
On sustainable investing.
On sustainable investing.
Correct.
I see. I think COVID heightened and exposed many of the weaknesses across different business sectors, and it highlighted areas of opportunity for sustainable investing that could make a huge impact. I think both Rebecca and Maria Paula spoke about some of these examples a little bit more eloquently than I did from the financial service perspective. I think from a progress perspective, the areas of opportunity I try to to focus on are in the incentives and the rewards for success. I think this is an area where the finance sector is uniquely positioned to really drive change, both from the enabling short-term rewards, but also enabling those to be more accessible to less incumbent companies. As Nana mentioned, I think that the point you made about a lot of distortion being created by those incumbent actors is very true. And I recently asked a very senior person from the United Nations to explain the difference between sponsorship and bribery as that pertains, because I think it's a very fine line. And really for progress, if the financial sector were to more democratize those instruments and allow them to be accessible to the entrepreneurs you were referring to from the global south and smaller companies, it would enable this to happen at a much faster pace than the slow lumbering oaf unsustainable companies that are responsible for us being in this position. So that's my start to those two questions.
Yeah, I mean, from Rivera's perspective, there's just a boom in ESG due diligence analysis and everything that came right out of the pandemic. I don't know exactly what the connection is, but for us, it was very apparent. I'm curious to hear from Rebecca and Maria Paula if that's their perspective as well, and to respond to the question.
If you want, I can go first. I agree. The outbreak of COVID has not stopped the growth on ESG investing, which has seen a remarkable rise over the past couple of years. And although the necessity of sustainable investment has been needed long before COVID started, I think that this pandemic was eye-opening for everyone, for regulators, for financial institutions, for corporates, and for everyone to really take care of not only our planet, but address the climate change issue that could bring more pandemics and more catastrophic scenarios to the world.
Maria Paula?
So from a financial point of view, I think that there was a belief in the investment market that ESG investments would not survive to a shock, and which the pandemic showed it was exactly the contrary. So there is a study, for example, from S&P Market Intelligence with the 17 largest ESG funds in the US market. And in the peak of the pandemic in April of 2020, 12 out of those 17, they outperformed the S&P 500. So it showed the whole market that yes, ESG investments, they are sustainable, actually sustainable. And more than that, the secondary market for green bonds, it opened before it opened for vanilla bonds. And when we started having new issuances, the oversubscription of green bonds was much higher than it was before. So we saw a lot of migration from regular investments, traditional investments, to ESG investments. So funds increasing by 50%, fixed income, green instruments increasing by more than 50% globally. In Brazil, we saw the same trends with funds increasing 50%, 200% actually now in 2021. And the market of green fixed income instruments just had a boom here in Brazil, so increasing by more than 240% this year. So I would say that almost 40% of all the international issuances that we had in the fixed income market, it was from ESG instruments. So it was really strong, and it is a trend that we expect to remain going forward.
And why do you think that's happening? What do you attribute it to?
So besides sustainable investments have shown that they are actually resilient, that they bring risk mitigation, that they indeed bring out performance. I think that there are new products coming to the market too. Because we have regulation coming out of what should be considered an ESG fund and what should not. And I think that regulation also helps investors to classify better their products. And we cannot forget that in the fixed income market, we had the sustainability linked instruments, both loans and bonds, giving more flexibility to companies that don't exactly have a specific project to be financed with a green bond. They still can have access to this, to a green instrument, which is the sustainability linked bond or loan, which is tied to a specific commitment related to sustainable issues.
Interesting. So now I wanted to check if you had other questions. I have one, but I wanted to check in with you.
No, I think those were the only two questions. So, if you can, you can ask your question and we can all answer it. Then we'll try to wrap up here. It's been great.
Well, I have just a personal curiosity, I guess, on venture capital and what's going on movements specifically in venture capital towards this area, et cetera. So I wanted to see if any of you had perspective or predictions on the venture capital market.
If you want, I can start with that one. We've, at least from Cultivo, we've seen a lot of interest from venture capital firms to invest in this asset class, in these technologies, and to address these types of issues. I think that one of the challenges that the VC firms are facing is the track record of companies that are involved in this space, just because it's a very new form of investing, very new form of making money, and that is a challenge that they are basically facing. But is something that not only the management teams of the VCs are requiring, but also the investors on those VCs are demanding more investment into these types of technologies that could help address the sustainability and the natural capital issues that we're facing right now.
And geographically, where is that happening for you? Where is that contact coming from? Is it?
It's very funny because it's globally. We've seen interest from firms from the US, from the UK, and even firms from Mexico that want to address these types of issues. Other very interesting thing is that it's not only traditional VC firms, but corporates that are launching their own VC arm really want to focus the investments of those funds into these types of technologies and investments.
Interesting. Mark, I believe you have some experience on this front in the States, in contact with VCs.
Me?
Yes.
Oh, it broke up. Sorry. I just had a pause there. Yes, we do. We have quite a bit of interest in the space from VCs in the US. The other thing I mean, it's very, I'll just say it's very trendy. And I see a lot of sustainability branding on VC websites also, like in the household ones as well. But I also wanted to say that I've just in research have become more aware of, thankfully, more investment going into the global South. I think Nigeria has seen a boom of investment. I think Rwanda has seen a boom of investment. I know Indonesia and Philippines as well. India, I think, has been there for a while, and China is I don't think China really counts as an emerging market anymore. It's pretty well emerged. And so the encouraging trend I see is to the point that Nana made earlier, that granted, it's still not equitable by any stretch of the imagination, but it's getting better. in the investments for venture capital and entrepreneurs in the global South.
Yeah, and I mean, if I could go ahead.
Go ahead, Nana.
Joe. If I could add a little bit to it, I do think that VC as an asset class has a significant role to play. If you think about the fact that they are coming in at the beginning of the funnel in terms of how, picking entrepreneurs and ideas and so forth and so on. So I think that that's an asset class that can make a big impact. And I do think that in certain areas like the financial revolution and the mobile revolution that, basically is changing lives around the world, being a big catalyst for that. So this has been very, very positive. I do worry, though, that the model that they are seeking in terms of the return expectation that they are seeking is not realistic. I mean, there's very few companies that you're going to invest in, and then in 8 years, it's going to be $1 billion business. That's not realistic. And the fact that that has become the expectation recently because of what's been happening in the last 5 years is in some ways going to take away from how much impactful that asset class could have. If you think about, but the expectation of making 2-3 times a whole portfolio and that becoming sort of what people are looking for because that's how they are getting paid on the carry and so forth. That I think is going to take away from the impact that it could have that it did start having 10 years ago when they didn't have these crazy trends. And so it remains to be seen how vintage of VC funds are going to change and are we going to see a dip? Because people that have studied it know that it goes in cycles, right? So the success becomes a self-perpetuating failure, and then they back away, and then they have the success again, and so forth and so on. Anyways, so that's sort of my view. But I think it's a very powerful force for good in terms of what's happening and can be.
And Maria Paula, how do you see this in Brazil developing specifically?
I see a strong trend of traditional companies investing on VCs in order to cover their gaps, especially in technology, but also in sustainability driven to technology. So in both in the corporate and in the banking sector, this is a very strong trend that we have been seeing here in Brazil. And sometimes two companies from different sectors like electricity and industrials doing partnerships through venture capitals in order to try to discover new technologies, for example, driven to electric vehicles or segments like that.
Super. Well, I think we'll move to closing. I'd just like to say I hope we can have a virtual coffee between the panelists because I think we're probably all working together. We just haven't worked together yet. And it'd be interesting to connect the dots. So hopefully we can set that up as a follow-up. But it has been an amazing conversation for me. Really appreciate the participation of you guys, and it's exciting to see these ideas and so much happening right now. I'll hand it over to you, Nana.
Well, thank you so much, Joe. And thank you so much and congratulations on great moderation. On behalf of the Economics of Change platform and Quintes, I'm very grateful for Mark, yourself, Maria Paula, who's a friend of the firm, Rebecca as well. And Mark, hopefully we can get to know you as well. Santander is a good friend, and Maria as well, Cortivo. It's a good friend of the firm. So is Reve, actually. So we're all friends here, and it's great that the exchange that we've had here. And to all our clients and sort of interested parties that are on this platform as well, in this audience, encourage you to go back and look at the other 6 different sessions that we've had on various topics about how it is that we can use business as a force for good. This is something that this platform is trying to do. We believe that. I think if I could put together sort of all the discussions here, there's 3 things that really strike me that I would like to leave it to all of our audience here in terms of reflection. And the first thing that comes to mind is really the need and the power of leadership. And this is something that Mark hit on really, and I believe that. And so I think we have a lot of leaders here in the audience. And I do think that courageous leadership, which is what I think Mark was talking about, is really what's needed, right? It's no longer good enough to be a leader that can check the boxes and sort of, keep it moving. But people really, in some ways, have to take a stand, right? And that's what this is talking about. And that's real leadership. When you take a stand that perhaps may not be necessarily so popular, and feeling conviction that in the end, you're trying to do the right thing. It's not easy. All of us are leaders, we know that, but that I think is a big think that we want to leave everybody here on a reflection perspective. The other point is really the value of thinking about externalities. And as we make decisions, all the people that are here, our audience, the decision makers, as we make decisions in terms of what we're going to be investing in, projects, people, etc., I think it's important that we spend some time to think about externalities, both positive and negative, because all too often we don't. It just becomes an ROI conversation, and that is limiting. And so I think that the issue of externalities is something that we want people to take away and reflect on. And then the last thing that I will talk about is, encouraging, especially some of us are leaders and have, lots of people in our groups, encouraging people to live lives of meaning and impact. And all of us clearly can find a way to be affirmative in our choices, right? And so whether it's about platforms that we visit, how we live our lives, brands that we participate, you can make this affirmative choice and you shouldn't feel like you don't have the choice. And so trying to kind of encourage more and more of that affirmative choice making in terms of how we live our lives, even for the most mundane things, I think is one of the things that I'm taking away from here, and I want to encourage everybody. On behalf, again, of the Economics of Change, I want to thank all our panelists, all of you here. Have a wonderful and safe end of the year, festivities and holidays. And we hope that notwithstanding Omicron variant of COVID, that 2022 brings to us a much better, most prosperous, and more equitable economic universe so that we can all continue to live our best lives. Thank you so very much. Have a great year.
Thanks so much, everybody. It's a great conversation.
Thank you.
Thank you.
Have good holidays.